Hello and welcome to ET Now. You're watching IPO Central and we are with Tata Capital. It's one of the biggest IPO coming out from the Tata Sons. And joining me is Rajiv Sabharwal, who's the MD and CEO of the company. So your IPO is opening on 6th and closes on 8th, price between 310 to 326. And when I saw the price, I was a little happy and I was surprised that in the unlisted marketplace, the price is over 700. And those retailers retail investors who bought the shares at 700 and are in a lock-in would be disappointed with the pricing in some way.
Actually, we don't watch that price. The way we've arrived at pricing is by getting feedback from investors, our book running managers, as well as getting a feel of the market. And based on all that feedback, the board yesterday decided to keep this pricing. In fact, the board decided to also keep this pricing slightly lower than the last rights issue price.
True.
I think Saurabh, the chairman, felt that we should look at how we can, take this issue to a larger set of retail investors and also look at how we can get them in larger numbers.
It's a big issue, 15,500 crores. You're raising fresh issue of 6,846 and offer for sale of 8,600 odd, which is there, where Tata Sons and IFC are exiting them through the OFS. How big a consideration was the current market scenario, the global tariff uncertainty, and the kind of FI outflows which we are seeing? And you are from the markets with vast, experience there. Was that a big consideration while pricing the issue?
I don't think so. We get into all these factors. If the markets are very buoyant on one day, it should not change our mood. Or if they're down the other day, that shouldn't depress us. I think we are focused more on building a good business which will last for generations. And that is what we are trying to do. If you look at what we have tried to create in terms of our asset book, we are one of the most well-diversified companies. We are spread across all sectors. But retail and SME forms about 90% of our total book. Not only have we shown growth at a very good pace of about 28% over the last 3 years, we've also ensured that along with that, we have kept our credit costs the least in the industry. So we are clearly focused on tapping the India opportunity and also ensuring that the book quality remains the best in industry.
You're the third largest NBFC by asset, in that sense 2.1 lakh crore of book that you have. Do you see growth and credit growth for NBFCs have tapered down in the last 12 to 18 months? Do you see that growth coming back, given the fact that now you have a boost of consumption coming from the government as part of GST and tax incentives which have come in, and over and above that you have RBI cutting down rates, which is bringing down cost of EMIs as well?
First of all, as we all know, we are all proud of being part of this country which is seeing the fastest growth across all large economies. On top of that, we've had the big boost of RBI supporting the market by bringing down repo rates as well as increasing liquidity in the market. The government has stepped in to bring about a significant reduction in GST rates, which has made the mood very buoyant. So if you look at the overall growth rate, I do personally feel that the growth rate may be better than what has been projected of 6.5%. We are actually walking into the festive season in the coming quarter. If you look at the whole piece and you peel a layer out of it, you will realize that even when the country grows at about 6.5% and credit grows at about 11 to 12%, retail and SME actually grow at about 16 to 18%. And when retail and SME form about 90% of our book, that's a big plus for us because we are already sitting on a market which is growing at about 16 to 18%. On top of that, we feel there is a big opportunity for us to take our products to more geographies in the market. And as we expand the distribution network in a phygital manner, because we do believe that phygital is the right way, combination of physical and digital. And as we expand, that gives us that extra growth to come in through our distribution. So, and that's the reason, if you look at the last 3 years, we've been growing at about 28%. And we do believe that India offers the potential for us to keep growing at that pace.
And that pace could continue because you are raising more than 6,800 crores in fresh capital, which will augment your tier 1 capital as well. So which are the segments which you see growing faster as we speak?
So, the money which we raise helps us to, as you rightly mentioned, to grow our tier 1 capital, gives us the base to grow more, and also allows us to invest in new age technologies like digital and Gen AI, which are playing a much bigger role now in the future. As far as specific growth of different categories are concerned, the biggest asset class for us is housing. And housing for us has been growing at a pace of 30% plus. We are also seeing consumer grow at more than 25%. We are seeing SME see a significant growth at 25% plus. So we have multiple engines of growth, and that I do believe separates us from the others, that you're not dependent on a single segment, but there are many segments which are helping you on this growth journey.
How does a merger of Tata Motor Finance help you? Because you have added commercial vehicles, cars and other portfolio to you. Are you seeing a similar growth trend in that segment as well?
So we got the final approvals for all the merger in May of 2025, so just a few months back. As far as Tata Motor Finance is concerned, they are present in an absolutely new segment in which the erstwhile Tata Capital was not present in. It's a commercial vehicle space. That's a large market with a book size of over 10 lakh crores, incremental disbursements of more than 1.5 lakh crores. So that's a completely new segment and gives us a new area, a new growth engine for us to grow in the future.
But how is it growing? I mean, the trend which you've seen initially.
The merger has just happened a few months back. It's too early to get into growth there. We are focusing more on making that business very robust for us, ensure that more of digital gets embedded into that business, and it makes the business more efficient. That's what we are focused on. But we are strongly of the view that in the future this will be a significant growth. With India spending more money on infra, with logistics becoming more important, I'm pretty sure that in the future the commercial vehicle market will also see a much better growth.
Expansion strategy, you spoke about the digital strategy here, and many companies in your peer group are focusing on digital strategy to expand, especially the consumer piece, which is very easy to tap through digital in that sense. How much is that, what is the kind of growth levers that you have there, given the fact that in the urban areas over the last 12 to 18 months, we have seen some kind of pause or slowdown in discretionary spends, and we see the digital pickup happening mostly related to urban areas.
Actually, we are seeing a significant leverage coming to us because of the investments which we have done on the digital side. Over the last 5 years, we would have spent close to about 2,000 crores on the tech area, partnering with best-in-class players. We've also focused on building digital journeys not only for retail, but also for housing, also for SME, and even on the corporate side. Right from origination to credit assessment, to debt management, as well as on customer service. So you will see almost all of our originations happening through digital mode. You will see 85% of our servicing happening through digital modes. We use business rule engines and scorecards to make most of our decisions. So digital is fully embedded in what we do. Similarly, on the SME side and the corporate side. Now the next wave where we have invested significantly is on the AI and the Gen AI space. We believe that this is going to be also a game changer in the future. And we do everything such that it can benefit either the customer or the organization, because we believe that if it benefits the organization, it ultimately translates into benefiting finally the consumer. So that is our approach. Just to give you a sense on some numbers, because of the investment in digital and in AI, we are seeing cost to income significantly drop. For example, in our housing finance company, cost to income in just 3 years back used to be about 40% plus, and in the quarter which just went by, it dropped to about 31%. So that's the power of digital. That's the power in future, which is going to be of Gen AI also, to bring in more efficiency. And not only that, to make decisions much faster for the customers.
But how do you manage the credit cost here? Because there is delinquencies coming in. Your credit cost has gone up. If I look at Q1, it was at 1.6%, if I'm not wrong, credit cost ratio at 1.6, which was there, and which is slightly higher than 1.4 at the end of March.
So you're right. I think our credit costs did see some increase because of the merger happening and the commercial vehicle business in the industry going through some amount of stress. But we believe that the worst is behind us and things will only be better in the future. As far as credit costs are concerned, what keeps our credit costs low is the mix of assets which we have. If you look at Tata Capital before merger, we always had credit costs of below 1%.
True.
And I'm pretty sure we will get to that number very soon.
Because it was 0.4 if I'm not wrong, and it went to
0.4
1.4.
So we do believe that we will get back to a below 1%, which is our comfort zone on total credit costs. And if you ask me today, are you seeing any stress in any of the segments?
Yes.
Honestly speaking, we are not seeing. In fact, as I mentioned to you, we believe that we've seen the worst, and the worst is behind us. And now what we are seeing in all segments of the business is credit costs only getting better.